So I want to make of what you're seeing in the pre-market right now. What do you think of this action? We're seeing, the NASDAQ pull back about 0.5%, the S&P down about 1/3%, after the market shrugged off that downgrade of the U.S. credit rating yesterday. What do you make of the declines in the pre-market today?
Yeah, well, I think the markets have had a really strong run. Again, just putting it back in context, we're back to flat on the year after having, obviously, a 20% sell-off from the peak, effectively, in the S&P 500. I guess the way I look at the market is we're back to the beginning of year levels. And keep in mind, back at the beginning of the year, there was a lot of optimism, a lot of expectation built into the market around the benefits of deregulation, tax cuts, and a lot of people were discounting the risk of trade war. What we've got now is tariffs that have gone from 3% to 18%. We've got higher outlook for inflation, lower outlook for growth. I think the market is due for more than a pause. I think the market's gotten ahead of itself. So seeing the market down a small amount pre-market, not a surprise to me. I think at minimum we need a pause here, but we probably need to reassess the valuation levels on the U.S. market.
All right, so Ron, your word of the day today is dispassionate. What are you dispassionate about? Seems like there's a lot of passion in this market these days.
Well, yeah, the reason I chose the word dispassionate, it's a bit of an odd one, is I think people need to step back and really just look at the facts I just laid out. A 3% increase, an increase from 3% weighted average tariff to 18%. The reason I care about that is every 1 percentage point translates to about 10 basis points of core inflation. So that 15 percentage point increase in the weighted average tariff should lead to core inflation going up 150 basis points by the end of the year. That means we'll be back over 4% on core inflation after just getting below 3%. That's a problem for U.S. consumers. Part two of this is in a dispassionate analysis, taking your partisan views out of the equation, taking emotions out. When you look at what companies are saying today, they've put decisions on hold. They don't know what the tariff and supply chain landscape is going to look like in a year, much less 5 years. And so in many cases, that's paralyzed decision making. And that's important because that slows down economic activity. And so when I piece all of this together, when I look at today versus the beginning of the year, I see a less favorable operating outlook for companies. I see much lower confidence amongst consumers, as you can see from the University of Michigan sentiment surveys. And I think that leads to a lower valuation, not a higher one.
All right, so Ron, in your scenario, you see inflation topping 4%. That means Fed cuts are pretty unlikely. How does that shape your view of the U.S. markets? And you also said you're seeing opportunities outside the U.S. where? We're going to show some ETFs, one for the Stock 600, one for emerging markets, one for China. All of them outperforming the S&P 500. But where do you see the opportunities at in this moment?
Well, let me start with the U.S. market first. I see a couple of big risks to the U.S. market. Number one, that higher inflation, exactly as you said, probably means the Fed does not cut rates at all this year. The futures markets are still saying we're going to get 2 rate cuts. I think it's 0. The other issue you see there is at the long end of the curve, 10-year Treasury yields basically right around 4.5%. We've seen a pretty big sell-off in Japanese government bonds overnight, 30-year bonds at the highest yield since they were launched in 1999. I think there's risk that we see discount rates, long-end rates in the U.S. go up.
Okay.
That's a threat to multiples on the U.S. Now, what looks good? Non-U.S. equity markets, I think Europe has still got potential. It trades at a 7 multiple discount to the U.S. Japan also trades a substantial discount to the U.S. And emerging markets are 9 multiples cheaper. When I look at Japan, I see capital optimization. Europe, I see a turning point fiscally.